Hi, and thank you everyone for watching. My name's John Cachia from AFA Group Wealth. I've got David Bassanese here from Betashares. David, thank you very much for giving your time. Do you want to just maybe just tell the viewers, who you are and what you're about?
Yeah, good to be with you, John. Yeah, so I'm the chief economist at Betashares, the exchange traded fund manager, I guess, providing a lot of exchange traded funds on the market. And my role there is to provide, basically exchange traded funds are sort of top down, sort of global macro type of investment approach, looking at different asset classes, equities. And so I provide, advice on how the economy's going, what's happening in investment markets, many years in economics, macroeconomics in various investment banks, and for a while at the Financial Review for a while beforehand. So that's really my background.
Yeah, beautiful. And Dave, thank you very much for coming today again, because it's really good for the people that are listening to have someone like David come in, and through our relationship with some of our partners, such as Betashares, we're able to have David, provide you with valuable information about what's happening in the economy. Let's get into it, because there's a lot of stuff happening in the economy at the moment. There's a lot of moving parts. We find ourselves, more than 12 months from the crash that we saw back in February, March last year, where, equity prices kind of fell out the roof. We do, unfortunately, right now find that both of us still in lockdown, hopefully not for too long. So the world has changed a bit, but, economically speaking, we've seen different countries do different things. And so one of probably the questions that I've got is, do you see any concerns in any particular economy, like the Australian economy or maybe the global economy as a whole? Do you see any particular concerns at the moment, just generally speaking? Or are you a bit, is there any concerns, or is there anything that you may be saying, yeah, no, we're going down the right way?
Obviously, COVID is the greatest economic concern. I mean, what we don't want to see is a variant of COVID emerge that is immune to the vaccines, and so that we need to go back into lockdown. I mean, and the vaccine rollouts, and go back to the drawing board in terms of finding vaccines. So at the moment, the Delta variant that's spreading around the world is highly contagious. It's, us included, cause countries to go back into lockdown. But the good news is that the vaccines, as we have them, do seem, effective against that variant. So that's a positive. If you look at countries that have rolled out that vaccine, the death and hospitalisation rates associated with the spread is a lot lower than we saw last year. So that's still the biggest risk to the economy. Bigger picture, we're starting in a position where unemployment we've had a V-shaped recovery globally. Like, this time last year, in fact, a bit earlier last year, we were debating, how fast we would get out of the COVID downturn. And really, the good news for investors has been it's almost the best case scenario we could have imagined, that we have rebounded. We still have, higher than desired unemployment, which means that growth can run at a strong pace for a while before central banks need to, tighten interest rates. So we're in what I call the purple patch in terms of the recovery. Okay. Growth can be strong without causing inflation, subject to the COVID. So that's really how I'm seeing the situation at the moment.
And are you seeing that countries maybe that are a little bit advanced in their vaccines, how are you finding their economies going? Like, obviously, we're talking about this COVID situation. So for some of the countries that are a little bit advanced in their vaccinations and they're starting to go back to a more normalized situation, how are we finding those economies at the moment?
Look, I mean, the US, I think, is the best case example. I mean, the US, around about half the population now have been fully vaccinated. And we're seeing, look, COVID cases are still rising in the US, but those that are sort of going into hospital, unfortunately dying, are those that are still, largely those that are still unvaccinated. So the economy is opening up. I mean, they've had a pretty strong recovery, and that's powering ahead. I mean, we're going to get GDP in the US for the June quarter this week, like national growth, and that's going to be 8% annualized. So, very strong growth after the first quarter, also very strong growth. So what we're seeing around the world is, as those vaccines, cover more of the population, you can learn to, I hate to use the term live with the virus, only in the sense that, yes, people will still get the virus, but they won't get as sick, and the risk of dying is even less than it was before the vaccine rollout. So that gives us some hope of, we can reopen and learn to live with the virus in that sense.
So let's hope we get out of this and we get back to a little bit of normalization, because it's good news. And obviously, from the US side of things, usually they used to say if the US coughs, we sneeze. So that's good to know as well too. In regards to then like certain asset classes, like maybe we can look over the the pond and look to the US, or even just locally. We've seen equity prices or equity values increase substantially across the board. The ASX 200 is higher at record highs, the S&P 500 at record highs, and we're looking locally as well too, and I'm sure this is overseas as well, but locally, property prices, direct property prices have shot out the roof as well. Do you see any concerns in the term bubble? Yeah, is any of these leading into a bubble scenario?
Look, it could lead to a bubble. I mean, look, what's happened is we've had this markets collapsed last year. So a lot of the rebound is just recovering from that collapse. And we've had this V-shaped recovery, so better than expected recovery. So earnings growth has been strong. I mean, earnings have rebounded, corporate earnings have rebounded. Now, at the same time, you've got central banks that have slashed interest rates. So lower interest rates put upward pressure on equity valuations and housing valuations. That's just the way that works. So, and central banks, not only have they slashed rates, they're now saying we're not going to raise rates for a couple of years because we want to see inflation pick up. We want to see labour markets tight, and so asset markets have got this window where interest rates aren't going to be a threat in a sustained way. So. If you look at outright, what's called price to earnings valuations, if you look at the PE ratios of equity markets, so earnings relative to the market prices, they do look high, highest we've seen since the dot-com bubble 20 years ago. But if you look at it relative to interest rates, it doesn't look that bad. And that's the problem. So valuations are okay, provided interest rates stay low. Relatively low, and I think that's likely to be the case. So I think valuations are going to stay elevated. I don't think they'll go up a lot more from here, but what is powering certainly the equity market is earnings growth coming through now. So that's what I think can continue to push the markets higher. And in terms of property, in a short answer, the RBA having slashed rates, property prices nationally went sideways for a couple of years. In Sydney, we had a decline in property prices before COVID hit. Now affordability has become quite good. And so when affordability becomes good, people respond by jacking up the price of houses. And that's what we're seeing around the country at the moment. A, because of the V-shaped recovery, B, because the RBA, like around the world, they've slashed rates and they're promising not to raise rates for a few years. So house prices relative to interest rates, as hard as that may sound to some, are actually relatively affordable compared to where we've been in the last few years.
And I think as well too, there's 2 points there. I think one is just in regards to the government's incentives around property as well too, that they've continued to kind of push that, push the backing of building and construction and backing the property market. We're also seeing, well, especially I'm seeing in Victoria as well, this spread out of the CBD, so into areas where there is more housing and new properties and stuff like that. So, from a, foot soldiers on the ground, yeah, we're seeing this kind of, continued growth, but a little bit actually more sustainable than I thought, rather than where it was maybe 4 or 5 years ago, where it was peaking to just these inner suburbs. Yeah. You got the lower interest rates as well happening as well too, which is, like you said, making it more affordable for people in the property market as well. On the equity side, and that was very good and very insightful. So are you expecting then a bit more of a flattening off when we talk about this V-shaped recovery, where we're talking about, pre-COVID, then a significant drop and then a market recovery, and then we're talking about the low interest rate environment kind of putting fuel onto the fire? Does that mean with, banks coming out pretty much saying we're not going to lift interest rates for a while, do you expect that, asset prices are just going to kind of level off for a little bit?
Well, I think the rate of growth in equity markets is going to, slow. I mean, we've had a fear, I think the market delivered something like 25% growth over the financial year, June on June. So you're not going to get 20. Well, I don't think you're going to get 25% growth. So again, in any recovery from a big economic shock, it's the valuations that respond first. Valuations collapse and then they respond in anticipation of the earnings recovery. And now we're getting the earnings recovery, which is driving the rally. And that earnings are growing, but they're not going to grow, that far. They're going to grow maybe high single digit returns, 5 to 10% type growth, with PE ratios, going sideways, maybe even coming down a little bit. So my expectation, markets can continue to rise, but maybe in the high single digit type returns on an annual basis, which again is still good, but it will be down from where it's been over the past year.
Yeah, it's interesting when I'm having conversations with many of my clients, the expectation of or what they've earned in the last 12 months. I'm trying to set the expectation of don't expect that year on year. It is coming off a very low point, and it's a very kind of unique scenario that we've just experienced in 2020. Just a couple of other questions that probably come out of that is inflation. And so there's a lot of talk around inflation and, there's just been so much money pumped in by governments that, there's a lot of money circulating in the markets. And, looking at our books when I was studying, you'd find, when you pump in money into the market, that will then lead to inflation at one point in time. What's your view around inflation, and is it a real problem? And are we talking about then, if it is a problem, are we talking about going back to the late 90s, late 80s, early 90s, where was paying rates at 18% at the bank? Like, what are we talking about when we talk about inflation and the expectation around that?
But when you do talk about inflation, you've got to sort of unpack it. And there's a lot of things going on at the moment. We've got short run, what's called supply chain bottlenecks. So we've seen inflation in Europe, in America, not so much in Australia, go up, because oil prices have rebounded, from the collapse last year. Used car prices in the US have gone up because there's been a supply shortage of new cars. So demand for used cars. So without going into it, there's a lot of little things that have driven, and also hotels have all increased their rates at the same time with the reopening of the US economy. So inflation in the US annual rate is very high at the moment, but it's seen as a spike high, and then it will, for that to be sustained, you really need, again, I go back to tight labour markets, wages growth across the board. We're not seeing that, and we're unlikely to see that in the US or in Europe or in Australia. So to the extent we've had this short run spike in inflation, I'm in the transitory camp that it's going to be relatively short run, and then die down somewhat. Bigger picture, the QE that you meant, the money printing, if you like. Ultimately, what's driving inflation around the world is what I call structural disinflation. It's tech disruption, it's globalization, which for work. The average worker, their bargaining power is being, not as great as it was a couple of decades ago. Technology is making things cheaper. Every year it gets cheaper to produce things. So these are keeping a downward pressure on inflation. And as a result, it's actually put the causality the other way. Because of low inflation, low interest rates, it's allowing governments to spend money because the markets aren't penalising them by jacking up interest rates. So, so again, despite all the so-called money printing and big budget deficits, I think the outlook is still going to be for pretty subdued inflation beyond this short-run hit that we've had because of the COVID-related supply bottlenecks.
Okay, beautiful. And I think that there's a lot, once again, with that 2020 kind of scenario that is not normal. Like, you're not going to see that level of investment. I think pre those levels was maybe World War II, when you saw those levels of kind of, money printing from government. So, I think I'm of the camp as well too, Dave, where I see this as a spike and then, it plateauing a little bit. I think there's a lot of this government kind of intervention that was required. We're talking about, a lot of businesses that literally had to shut their doors. And in my living history, and I think most people's living history, we can't recall a government coming out in Australia and saying, you have to close your doors. So, they had to do what was required to be done.
Yeah.
I think another one which I've been getting a few questions from clients about is in regards to the what potentially the new world looks like. And what I refer to the new world is this large level of investment commitment from countries around the world into like renewables and clean energy and stuff like that, which, for me is really exciting. I think that, for me growing up, it was around this new world of the internet and what that looked like. And I think that the new one for me, especially with some young kids, is around, giving back to the world in a good way, and investing in technology that will help us to live cleaner, live more one with the earth and not ruin it, maybe as we have over the last couple of 100 years. From an investment perspective, what does that look like? What are governments actually doing down this path, and what does that mean for the investor?
Look, it's funnily enough, it's actually not so much what governments are doing; it's what the private sector themselves are doing. I mean, as we know in Australia here, rightly or wrongly, climate change is still a hot political issue. I mean, the government's probably been dragging its chain a little bit on embracing it compared to, say, some European countries, and even the US up until recently. I mean, Biden in the US has been an absolute game changer, of course. I mean, under Trump, there was a lot of resistance to encouraging clean energy. Biden is changing things dramatically, but what we've seen is the private sector, just through consumer demand and desire, and also technology lowering the costs. Solar energy is falling in price, wind energy. People are getting solar panels put on their roofs, which is cutting their demand for coal-fired electricity from the grid dramatically. So it's a lot of private sector initiative that's driving it. Governments are encouraging it. But in different ways around the world. But actually, I think what's happening, it's really being led by the private sector, which is good in a way, and it's technology driven. Right? Rather than having to jack up a carbon tax, let's say a tax on carbon, what we're finding, I think, increasingly is that the technology is driving down the costs of non-fossil fuel energy. So it's allowing that shift to happen even without that carbon tax. So that's pretty good. I mean, the other point, everyone's going, we're going to net zero emissions by 2050. I mean, most of the experts, again, agree that we need to get there to avoid terrible global warming, and even the risk of that is still, getting quite high, unfortunately. But that requires not only clean energy, it requires a lot of changes in agriculture and the way we build buildings, energy conservation. So there's a whole range of things that are going on. And as an investment thesis, I mean, it's a very strong growth thematic in its own right. So whether you're a greenie or not, there's a lot of money to be made in investing in these technologies beyond, clean energy, of course, but in a whole range of other areas as well to basically reduce carbon emissions over the next couple of decades. The required changes are going to be very, very substantial.
We're seeing a lot of companies as well too coming out with policies around this now, like you said, around the private sector. We're seeing that most companies are coming out with a policy and the way that they want to kind of change, and which is amazing because like you're saying that companies coming out putting pressure then on governments, and then governments kind of saying, yep, this is the way we're going to do things. That's what kind of excites me, and you can call me a greenie or not a greenie. I love the world we live in. I think that it's beautiful that we can go outside and smell fresh air and do all of these things. And, I hope that my children, get to experience the lovely outdoors like I've experienced. So, that investment really excites me. And from an investment perspective, I do see a lot of companies that maybe weren't considered traditional greenies, moving there, which is quite good. David, maybe just and I did want to keep this chat pretty short and sweet, but just like generally, are you considering the next couple of years as maybe the glass half full or the glass half empty? There's obviously a lot of talk on both sides of the camp, but what's your view on the global economy and the local economy?
Look, I'm in the glass half full camp. I mean, the way I boil it down to where we are in the cycle. Like unemployment in Australia has come down. It's 4.9%. The RBA would like to see it in the low fours, if not the threes, which is a big sea change from the Reserve Bank. And they want to get again a tight labour market to see if that can generate some wage inflation. Because inflation in Australia is too low for the Reserve Bank. And we're seeing that around the world. Central banks are now encouraging economies to run hot to try to get inflation up to where they want it to be. So low inflation, high unemployment gives us a platform for good growth without central banks getting in the way and taking away the punch bowl from the party, so to speak. So I'm in that glass half full camp. As long as there's spare capacity in the world and there's inflation that is low, for structural reasons, as I said, very importantly, those structural reasons, but also because unemployment rates are still higher than we would like. That's a platform for good growth, and that's what keeps me in the glass half full camp.
Yeah, good to see, good to see. And I do feel a bit the same in regards to the glass half full. There's a lot of good things going on. I know there's always some negative things, but that's how the economy works. If everything was positive, we'd probably be more concerned. So that's it. Right. Well, David, thank you very much for giving us your time today. We really appreciate it and love the valuable insights into this. So everyone who's viewing, if you've got any follow-up questions, please let us know. David and the team at Betashares are always happy to help us. So thank you very much.
No worries. Good to be with you.